Fractional reserve banking, how it works. In order to understand what banking cartels have been doing since the 16th century in England, we need to understand the concept of fractional reserve banking. Academic study of the modern banking system tends to be formulaic and mathematical and disconnected from the societal impacts of fractional reserve banking. We are educated to trust that the system is good for us and consider 25 and 30-year mortgages or 5 and 10-year car loans and credit card debt to be normal parts of life. Most people growing up in the current system are stuck in a perpetual debt cycle. There are many that cannot escape the cycle of long-term debt without foregoing basic needs of food and shelter. Most of us are not educated with a functional understanding of the key issues associated with our fractional reserve banking system. Often discussion of the topic is clouded with formulaic theory and ideology when the reality of our system is incredibly simplistic. Fractional reserve banking system is a magic trick. Banks are given the power to take a small amount of deposits and create much larger sums of money with it. And unminting of the currency according to the whims of the banking cartels is a trick repeated over and over throughout the pages of history. Some people play the disappearing card trick, the banks play the disappearing money trick. Now you see it, now you don't. Why is this a problem? We'll get further into that, but essentially it gives banks the power to claim interest on the money they create, which you have to pay back. Every time the banks create money out of nothing, which is how most of the money enters the economy in our bank-dominated system, it dilutes the value of dollars that you already hold. A fractional reserve ratio refers to how much money a bank is allowed to create. The amount of money that banks are allowed to create is generally dictated by the central bank of the nation in which a bank is based. The actual amount of money that is created can be measured as the money multiplier, which reveals how much new money is being created. The total amount of money in supply is measured in economic circles by the term M1. Fractional reserve ratios have been stretched via various tricks so that the actual amount of money created is much higher than it was prior to the progressive deregulation of the financial industry over the past few decades. The massive amounts of money creation have been made possible through modern tricks such as collateralizing loans, which is basically wiping loans off the books so banks can make more loans. Derivatives markets have also massively expanded the money supply, thus reducing fractional reserve ratios. As a result, reserves get lower and money creation goes through the roof. As a result of this, banks are often given license to essentially lend as much money as people are willing or able to borrow. 10% reserve has been the standard ratio historically to lend $9 for every $1 held in reserve. In recent years, the standard has increased in many cases to 30 to 1 and in some cases 100 to 1. In fact, the ratio has even been documented at over 300 to 1 in some risk-hungry investment banks such as Goldman Sachs. At such high ratios of money creation, there is a lot of money being made out of nothing by the banks. This inflates prices dramatically and generates bubbles in markets such as real estate, stocks, and other